Hey, good afternoon, everybody, and thank you for joining our Pieces of the Puzzle webinar today. We are going to be navigating the 2024 SFR world and landscape. We're going to be covering various topics today, including performance of SFR and BFR assets, supply and demand dynamics, expected performance, emerging trends, rental trends, affordability, cap rates, potential recession, and more on the discussion. I want to thank you all for joining us and our esteemed panelists today. My name is Michael Finch. I'm here representing SVN SFR Hub Marketplace and our SFR Hub companies. And we've got three great guest speakers today that I'm going to let them introduce themselves. I will start with Brad, and then we'll go to Justin, and then last but not least, Peggy. Brad?
Thanks, Michael. Brad Hunter. I am the founder and president of Hunter Housing Economics. We are a nationwide firm doing build-for-rent studies. We've been doing studies lately in all parts of the country, actually, from California, Arizona, Minneapolis, St. Paul, the Texas markets, all the Carolina markets, Georgia, Florida. It's been enough to keep us pretty busy. So we study all three food groups of build for rent: the single family detached homes, the cottages, and townhome duplexes, and the like.
Thank you, Brad. Justin?
Good afternoon, everyone. I'm Justin Parker. I'm the CFO at RCN Capital. RCN is a nationwide private lender focused on deploying capital against residential assets spanning across construction, fix and flip opportunities, short-term and long-term rental, multifamily, and portfolio as well. Headquartered out of Connecticut, we also have offices in Charlotte, North Carolina, as well as over in California. And thrilled to be here today.
Thank you. And Peggy?
Hello, everyone. Peggy Dalton with Stewart Investor Solutions. I have the opportunity of leading a fantastic team that oversees default services and investor solutions. And we offer a national solution, all 50 states, in addition, U.S. territories. I partner with our Stewart services acquisitions that have been made over the last couple of years. I feel like the partnerships I have with Stewart are unstoppable, and I think that we're the leading provider for investor solutions in the country.
I agree. You guys are a juggernaut in the industry for sure. So we're going to start off today with Brad Hunter putting on and giving us a presentation, be about 8 to 10 minutes, kind of a general overview. But he's got some really good insights, specifically in the BFR sector. And then when he's finished, we will engage in conversation and then save some time at the end for a Q&A for any audience members that may want to write in some questions. So Brad, please take it away.
All right. Thank you. I presume everyone can see my screen. I'm sharing a slideshow that I'll just talk through for a few minutes. And as I said, we do site-specific market studies for build for rent all around the country. And here's some of the things that we have observed. This is a data set that we put together using CoStar data. And it just shows, that the two hottest types of build for rent in terms of just the rapid growth that's occurred over the last 6 or 7 years have been townhome build for rent communities and cottage style detached communities or horizontal multifamily, however you like to say it. This graph shows you the rental townhome deliveries from 2016 through 2013. And it shows that Dallas-Fort Worth is the #1 market in the country in terms of units delivered. Phoenix, #2, a fairly distant #2 at 2,426 units over that period, just for townhomes. Atlanta is an interesting market. It's kind of been on again, off again with some moratoria in some jurisdictions, but I've heard about some jurisdictions there actually lifting the moratorium. So that's started to allow more activity there. Houston, Charlotte, Tampa, basically what we're seeing is everything moving eastward. Phoenix and the rest of Arizona were sort of the birthplace of build for rent. And everything then spread into Texas, to Colorado, and then to the Carolinas and Florida. And it's really an early innings in the East. So it's really interesting to see how this is going to play out over the next few years. This graph is a similar ranking, but this time looking at the horizontal apartments. So that's your cottage style. And it's a fascinating product that really the birthplace of that was heavily in the Phoenix market. So that's why you see Phoenix edging out Dallas in this graph for the #1 position. Again, a pretty strong lead over the #2, which in this case is Dallas-Fort Worth. And Phoenix is interesting because even though a lot of product has been built, we're still seeing some pretty good metrics there. I just had a conversation with Josh Hartman, the CEO of Next Metro, one of the pioneers of horizontal apartments in the country. And they started out there. They started out with a project early on called a Villa Cantera Crossing in Goodyear, and opened strong. And then when somebody else opened across the street and another opened catty corner to them and another one a mile away, there was no measurable change in the metrics versus the others. They're still 96% leased after those opened up, and still at pretty good rents. Rent growth has slowed down on kind of an effective basis, but rent renewal rates are still pretty strong in that market, which is really fascinating. I always think of Phoenix as the canary in the coal mine, since it's got so many units. If any market is going to end up with some submarkets being oversupplied, that'll be the one. A lot of people ask me, hey, you know, this market's getting so much attention, so much money pouring into it. Are we overdoing it? Are we heading for a train wreck of too much build for rent? And the answer is clearly a decided no. We're nowhere near saturation in most of these markets. You know, that's why I'm looking so carefully at Phoenix. If it occurs anywhere, it'll be in some of the Phoenix markets, but we're not seeing that very clearly yet. We'll continue watching. This is my forecast for nationwide build for rent housing starts. So this is the supply coming into the market. You'll notice that I'm forecasting a very strong drop off in this year, from 116,000 last year to 81,000 this year, about a 30% drop. And that's purely a reflection of the lack of financing. And Justin, I'm sure, will have a lot to comment on that topic. But the you know, capital has pulled back, debt and equity. I think that probably debt is the bigger problem than equity, although some of my clients say it's the reverse. So this number would drop even farther than that, except for the fact that I think that the public home building companies will probably continue their pivot towards build for rent, especially if mortgage rates don't come down as much as maybe they are hoping. So what this is creating is pent-up demand, because let me add in the demand numbers here. And what we find is that there's now going to be this decline in production that's going to create pent-up demand of a pretty significant magnitude due to that lack of debt and equity. And that's going to create opportunities for folks who can deploy some dry powder, come into this market. You know, oftentimes the lenders lend when they shouldn't and don't lend when they should. And I think this will be an opportunity this year and going into next year to buy deals from undercapitalized players, people who can't close, people who can't refi. And this is just a map we created to show the projects that are filling in between San Antonio and Austin and some of the other markets in the country. Here's another example, filling in between the Tampa market and Orlando market, more and more spreading out. So these secondary market locations that are a little farther from the urban core are successful. They're finding demand, and people are willing to go a little bit farther than they would for an apartment, because they can get some private outdoor space. And for people that have young children, that's a big deal. If people have dogs, it's an even bigger deal. And so that's partly what's driving this build for rent trend. I think this will be my last slide, just to quickly comment on the so-called BFR premium. So what's the premium over apartments? So we've surveyed people all around the country, and we said, how much more would you be willing to pay than your suburban apartment rent to live in a rental townhome. And then we also ask about a detached single-family home. And what this shows is that depending on what people are currently paying, the number can go higher. So for example, people that are currently paying $1,800 to $2,200 a month for their garden apartment are willing to pay $300 or more a month just to live in any old townhouse. Because there's clearly advantages to having less dense, backyard, maybe a garage. And then you add another $200 to get to $500 premium if you're in a new townhouse in a build-to-rent community that has some professional management, cohesive development, and so on. And then you add in amenities and green space, and it can be as much as a $600 a month delta between apartments and BTR. And then this also allows you to see the delta between the scattered SFR and the BTR. So with that, I will kind of wrap up my comments and let the panel chew on some of that, and I'll be open to jumping into the discussion after that.
Wonderful. Well, thank you for that, Brad. And Peggy or Justin, do you guys have any comments or questions on what we just presented? And I do have one comment question for Brad as well. But if you guys would like to jump in or ask for any clarity or questions regarding what was just presented, please feel free.
Yeah, definitely. I mean, I'd love to maybe make a comment and add a question in here. And Brad, thank you for that information. I think that level of data is incredibly valuable to be able to see what's going on throughout this industry. I thought there were a couple of things that were interesting. First is going back to, I think it was the second and third slide when you're talking about some of this increased inventory that's occurred. You made the comment that we've seen a migration east, if you will. And I think there's a lot that really drives into that. And a lot of that is a dynamic of what we've been battling against as it pertains to fiscal policy in the US. As we've seen this increased rate environment that has impacted us all in many different ways, it's a lot harder to pencil out those higher dollar projects as compared to what it used to be. And it's a lot easier to find, call it the low to mid-tiered affordable housing, and make the numbers work at these higher rates. We'll have some Q&A and some topics that we cover later that I think dive into it. But I think that chart was really a great example of kind of showcasing how penciling out has impacted where a lot of these projects have taken place. Because, you look at the West Coast, it's really, really difficult to make sense of projects when you can't make the numbers work based on the rates being 2-3x what they used to be. And another thing that I thought was really interesting, and I'm actually more curious, Brad, just to get your own opinion on it, is you were talking about Phoenix a little bit, and Phoenix is really unique to me, and I would include Austin, Texas, as a good example with Phoenix as well, where these are areas that have seen tremendous population inflow for a while now, and the pandemic was throwing gasoline on a fire, right? People were flooding into these cities, and there were a handful of others around the country as well. And it's interesting to see that the inventory is there and being supported by the average consumer, the average renter, if you will. One of the things that I've noticed, and maybe it's a little bit more on called an individual property level, but these MSAs saw pretty significant HPA during that period of time, call it 2020 to 2022. And as a result, we're kind of seeing it pull back a little heavier than other metros as well. So it's a very interesting dynamic where we're seeing, call it a very heavy rental market that seems to be operating and being fulfilled at high levels, but simultaneously we're seeing a little bit more flex from a housing fundamental perspective. I'm curious to get your input there as well.
Yeah, absolutely. Your first point about that, again, underscoring the push eastward because it is harder to pencil deals perhaps in the West. I've been to a lot of conferences where people have said, hey, you can't make build for rent work in California, but actually you can. There's a bunch of examples of build for rent working great in California. So it can work even in expensive areas. It is, as you said, harder to pencil. It's harder to make deals work with the cost of capital where it is, and people talk about negative leverage and how much longer can we do this and so on. But I also look at my own consulting business, and we do these market studies. we are probably down a little bit in terms of our volume in the last couple of months, but not as much as one might have guessed. So what that tells me, people are still coming to me and saying, hey, let's, we need to do a market study. They do want the studies because they need something to show to their lender or their capital partner to, demonstrate with something hardcore that this deal makes sense or that it doesn't make sense. And, we'll stop our work midway and say, hey, it doesn't work if that's the case. But people are still coming and still finding that their lending partners are willing to go forward. So it is harder to pencil, but it's not impossible. To your second point about Phoenix and Austin and the population inflow and the changes in home prices and so on, those markets are ones that I always watch very carefully because, yes, not only has that dynamic happened, but also a lot of multifamily is being delivered in those markets. And so we have to watch. And so, in all of our studies, we look very carefully at the pipeline, what's coming in, how much of that is going to be competitive with a built for rent project. So what that means is that segmentation and diversification, differentiation are of key importance now, more so than ever before. So you really have to know who is your renter, what is their financial situation now, what is it likely to be in 12 or 18 or 24 months. And so you have to just think forward a lot more. And then, if there's a recession, that plays into the calculation as well.
That's awesome insight. Thank you. And one thing that I kind of add to that, and I know we're going to speak to this later on, but when we're talking about the trouble of capturing debt and equity that you were mentioning, I think you hit the nail on the head there, where it's not as much because people don't want to deploy debt and equity. It's because penciling it out is not near what it used to be. And there's a lot more scrutiny around stress testing these transactions. So I think that's a fantastic point. Thank you for that.
Yeah, and then Peggy, I'll jump in with you here in just a second if you have any comments or questions on Brad's slide. But Brad, if I was reading between your lines correctly on your third-party reports, are you suggesting that debt and equity doesn't take sponsorship numbers as gold?
I hate to break that to you, Michael, but that is the case.
No, I for all of you listening, if you haven't worked with Hunter Housing Economics, I implore you to use our third-party feasibility studies. They're phenomenal. Peggy, any questions or thoughts on Brad's presentation?
No, I think that Justin covered most of it as far as the eastward progression. We are seeing more activity. It matches up with Brad's slides from an eastern standpoint. We're still seeing small parcels being purchased for development. And Brad, being in the Tampa area, I enjoyed the slide, the Tampa to Orlando area. And it does match up with what we're seeing here.
Yeah, and just one comment and then a question for clarity's sake, as we were talking about it just as a group here before we started the webinar. Comment, I was reading an article in MoneyWise yesterday, Justin, and I was talking about the migration from the blue states to a lot of the red states with about, I don't know, the last few years, like 5 million people have migrated, and a majority of that follows those slides that Brad was showing, moving to the Southeast. And I thought this was just an interesting fact. This is the first time in the United States history that the Southeastern states, which include five or six states, now have a higher GDP than the Northeast due to that migration, which was really interesting. And I think for clarity's purposes, because we were talking about it here before we started, Brad, could you just, for the audience, and I know most of the audience today has a better understanding of differentiating the cottage style or horizontal BFR product compared to townhome or detached single family home BFR, but could you just give a quick clarity perspective or description on the differences of those asset classes?
Sure. So terminology can vary from horizontal apartments to cottage style multifamily or cottage style homes. And what it all refers to is a development on a single plat of land, typically 100 to 150 units, small units, apartment-sized units, but detached homes. So the advantage there is fewer shared walls, or often and usually no shared walls. It's a completely detached home with a little bit of private outdoor space, maybe a fenced backyard, that type of thing. So somebody that wants the single family lifestyle, but doesn't need quite the space of a large single family home or can't afford one, these kinds of cottage communities are turning out to be extremely popular. So they're popular with a few different groups, millennials, young professionals. Families gravitate more towards the townhome, single family, detached home, but couples, singles, divorced people, if it's the horizontal multifamily, cottage style. You also get transitional households, people that are between jobs, people who are recently divorced and maybe even a single parent. And then you have empty nesters. That's another one. Lakewood Ranch, that's one you're aware of course, Peggy, in Florida. They were surprised how many empty nesters they got in their Estia built for rent community there.
Yeah, it's interesting. I think the main distinction is really the demographics of the tenants between a larger fee simple home build for rent community and the cottage style product. And I think my old view is being proven wrong, Brad, just by based on some of the things that you said. The cottage style product 100% does not compete in my mind with more traditional build for rent, single family home build for rent models. And we all know here that the multifamily sector is arguably a little overbuilt on the supply side in the country today. Given that they're competing for the same tenants, how do you see the cottage style or the horizontal build for rent? Because it sounds like it's outperforming still, based on some of the things that you said. But do you think in the long run they'll fare better because they're offering such a niche atmosphere compared to traditional apartments?
Yeah, they will, and that's because of a couple of things. Number one, if you want the privacy that comes along with having no detached or no shared walls with your neighbor, that's a huge one. Also, if you want some private outdoor space, if you are a single parent with a small child, you want a little space for them to crawl around, run around, and then you add to that if they have a dog, and millennials have dogs at a higher rate than most other generations, then there's such a huge lifestyle advantage. Instead of in an apartment having to grab the plastic bag, walk to the elevator with leash in hand and go outside through the lobby and all that, you just let the dog out the back door, or even have a doggy door. So there is a huge differentiation between the cottage style and typical apartments. And as you said, it's showing up in the numbers. People will pay a significant premium over apartments to have one of those cottage units. They are leasing up quickly, and we're still seeing more rent growth there than we're seeing in apartments.
That's interesting. And then they're willing to drive a little bit further just to have that space as opposed to a stacked apartment unit. So moving on, and thank you for all that. Want to talk, and first we'll get, because Brad shared some thoughts, but maybe he has some more to add on where we anticipate the trajectory going in 2024 regarding the entire world, scattered single family rentals and build for rent, regarding vacancy rates, rent growth, pricing. Maybe I'll start with you, Justin, and maybe focus a little bit more on the scattered single family asset space. But where do you see 2024 going for all the investors and people listening in today?
Definitely. I mean, looking at, call it scattered detached, we're expecting continued growth across the sector. I mean, really every MSA throughout the country. And the reason, and we'll touch on this a lot today, is really boils down to affordability. as I look into, right now, I think everybody has a good sense that it is extremely hard to own a house if you're going to be a first-time home purchaser, right? Rates are through the roof. Home price appreciation has been unprecedented over the last few years. It's really hard to make that work from a salary and wages perspective. So we've seen that migration continue to flow towards rent growth in terms of rental units, et cetera. And, as I look into 2024 and really beyond, I think as we're looking at the year, everybody is pretty much in agreement that we're going to continue to see rates decline. But where I still see an issue is that's not going to solve the home price conversation. I personally am of the belief that as rates continue to come back down, we're going to see this wave of demand re-enter the space from an owner occupancy perspective. And that's going to trigger another wave of home price appreciation to where you're still netting about the same position that you're in today as it pertains to, what you can afford. So we expect to continue to see more, and both from a detached, scattered, as well as a B2R form, right? I think any rental units across the country, we're expecting to see significant growth in sizable ways. And to me, it really boils down to that major topic of affordability. Now, I do think that there are some things that we're looking out for, and I'll certainly touch on those later as it pertains to the consumer and the health of the consumer. But as it becomes harder and harder to make that mortgage payment, couple that with the fact that taxes and insurance are skyrocketing compared to what they used to be, it is just pushing more and more people into that rental environment. So we fully expect to see pretty significant growth there. And to kind of add to Brad's point earlier, he was mentioning dogs and millennials, and it's actually, there's been waves where people were buying houses because of their pet. It's such an interesting way to understand that the demographics of the market you're in really have an impact on the project you're putting together, the amenities that you build out, et cetera. And, I'd certainly love to hear from Brad more about that, but I do think it's going to be a big year for the rental market, all things considered.
Yeah, and affordability is key on everybody's mind. I think I read, the Fed is, everybody's anticipating rates to come down, and I think the Fed earmarked maybe 75 bips this year. But we got to remember that they rose at 525 bips in the last 18 months.
Right.
So that's a pretty small dent in the overall opportunity to make things more affordable. And to your point, Justin, I think if I think it's for every 100 bips in rate reduction, it reduces the cost of ownership by like 10%. But if values keep going up, which they seem to be doing outside of Phoenix and Austin, like you mentioned, everywhere else in the country, values have continued to appreciate. And they're already at all-time highs. So affordability is certainly going to be a challenge. Peggy, you've got such a unique view given all of Stewart's companies, not just on the transaction side, but data and everywhere. What are you seeing? Where did the year end? Where are you seeing 2024 going?
There were a few surprises at the end of 23. We're seeing activity in all aspects of the investor space. There wasn't a front runner, there was activity in every aspect. So we saw an increase in apartment complex purchases towards the end of the year, which was a surprise to us.
That's surprising.
And they were resales, they weren't new construction. We're seeing an increase in leasehold investment structures that's a little bit different than what we've seen in the past. As far as 2024, we've experienced an increase in MLS sales in areas where our investors may want to exit, and reinvestment in the eastern states. So, there's activity everywhere. I think that for each investor, they're finding their spot of generating income. The securitization opportunities are there. Right now, the securitizations we're seeing are smaller. Towards the end of the year, though, with our addition with BCHH, we saw some larger securitizations come across. So it's been active. There's not been a front runner in any of the active markets.
It's interesting. And Brad, anything that you think is interesting to note, or something to be looking out for in 2024 that you may not have covered in your presentation?
Well, I see a question from the chat that kind of touches on something, which is Jeff asking about the amenity light, fee simple, BFR versus cottage apartments. And I think that the thought there is the market is quite diverse. So you've got a lot of different types of renters. Like we talked about, families, singles, roommates, empty nesters. So I think that there's demand across the board for all of those different types. So that I think you can do fine with a strategy of amenity light, and you can do fine with a heavier amenity strategy like these cottage communities are doing. And I think it's healthy that there's a diversity of these kinds of products. If everyone was doing the same thing, we'd probably be in trouble. But it is quite diverse, and so I think that there's plenty of opportunity to go around.
Yeah, I agree, and I think, if you're 120 units or over, and not the cottage style, but traditional townhomes or detached single family homes, and it's all market driven, of course. You probably don't need a pool and clubhouse in Minneapolis, but in a lot of markets, and the jury's been out for many years, and it's been more theoretical, but we're starting to see a lot of data and hearing from property managers that, over 120 units, the BFR communities that don't have pools, and walking trails, good open space, we're starting to see that may have more an effect on tenant tenure than it does on your lease rate, but tenure is important. So I think it's something to consider when you're looking at developing these deals with regards to amenities. Because obviously a pool is more expensive, there's more liability, but if that does help lease up the property and keep your tenants in place longer, it's probably a benefit. But again, if it's 70 units, it's probably an expense that's not necessary. Moving on, let's see, how do investors in the SFR sector perceive the industry's short and long-term prospects? And this is in consideration to geographical footprint, leverage, debt, spread taken into account over the investment strategy. And, this may even lead into a little bit of, are we or are we not going to see a recession? But, Justin, maybe we start with you here from a lender's perspective on your perception of the short and long-term strategies, and, where you're seeing geographically more loans being placed.
Yeah, I mean, it is such a market and timing driven conversation point, right? We have always loved, and I think most operators really like, the long-term strategy. You create more stability. You don't have to worry about vacancy as much. There's a little bit more of a stable tenant. I think most operators around the country still have a lean towards that direction. But as we've seen cap rates increase, right, we've seen rates move up. There's been a lot more demand to create higher, gross rental revenue. And by doing that, we've seen a lot of migration towards short-term rental properties, short-term rental tenants. And I think, if you're asking for my personal opinion, I think there is a little bit of opinion that comes into this conversation, but areas that are really built on short-term rental markets, beach towns, mountain properties near ski resorts, those kind of things, they've really performed pretty consistently, because that's always been the strategy of how to create rental revenue in those, tertiary markets. But if you're looking at, say, the Charlotte, North Carolinas, for example, where I'm based, there's been people that have tried to migrate towards that strategy just to go capture a little bit more revenue. And it's been very up and down. You have to be very, very confident in your ability to keep that property occupied and really try to limit vacancy as much as possible. And as we've started to see some of that stimulus money work itself out of the economy, we've started to see less demand for short-term rentals. And as a result, it puts a little bit more strain on cash flow. So we really see it successful in areas where the market is built around that strategy. And I go back to a beach town or a mountain town or some of these areas where vacation rental is a very stable environment. But one thing that we like a lot, and we've seen work really well, is what I call midterms, midterm rentals, if you will, traveling nurses or people that are looking to occupy a property for, call it 30 to 90 days, where they kind of fall into that gray area, if you will, but you still get the increased revenue. You get a little bit more stability in the tenant. It's really just about knowing being near a hospital is a great area, right? Because you get traveling nurses that come in and work out of that hospital for a while and stay in that property. I think there's a lot of opportunity there, but to answer your question directly, it's really about understanding the market you're in and figuring out if the demographics support the strategy that's in place. I think that is, I don't think there's a right or wrong answer as much as it is making sure you're taking the right approach to the geography you're operating in.
Sure. And Peggy, I'm going to get to you next, but just a follow-up question for Justin, and more focus on, the longer term investors and strategy with, year or two lease type of tenants. Where do you see, where is the leverage and the debt spread being taken into account today, and where do you see that going, or changing over the course of the year?
Yeah, typically speaking, these projects are built on cash flow. So leverage, while it hasn't really moved away too much from, call it, historic norms, it's naturally lower because properties can't cash flow the way they used to. So naturally that 70% LTV drops to 60 because of the implications of tighter cash flow due to those higher rates. And we're seeing the natural regression there. But it's really more of a cash flow driven exercise as it is us not having confidence in the valuation of these properties and the equity within, right? I think there was a period of time where maybe there was some sensitivity around high rates could impact home prices pretty significantly. We've seen that the housing market is way too resilient to allow that to happen with the undersupply that we have. So leverage really hasn't seen too much of an implication, primarily due to cash flow kind of working its way into that equation anyways. And when you're looking at spread's interesting. I think, spread is widened out because there's a natural value add onto the capital that's being deployed throughout this sector, especially as people have moved in and out of the market. The market's been very volatile over the last, 12 to 18 months. People slap on a little bit more for the risk that they're taking on to deploy that capital. It's tightening and it's going to continue to tighten. I think there's a couple of things that are really going to drive that. Insurance monies continue to have a high level of confidence towards the paper that's being originated in these industries, and that allows for a little bit more spread compression. I also am seeing a lot of positive trends from a securitization perspective as well. There's a lot of spread that's been built out of the bonds that have been printed over the last couple of years, and as that's tightened, naturally the debt spreads are going to continue to tighten as well, with lenders of all types. And I think it's also going to lead, this conversation isn't necessarily a conventional mortgage conversation, but when you look at the conventional mortgage world, Michael, you're talking about the Fed having 75 basis points baked in, and that's absolutely the case for this year. But, if you look at spread differential for what's occurred over the last couple of years, typically speaking, there's, call it 100 basis points over top of the 10-year for where 30-year conventional rates are. And up to this point, it's really been more in the 200 to 300 basis point area. So while rates come down, there's still a tremendous amount of opportunity for rates to come down quicker, assuming that demand enters the space and that compression continues. So there's certainly opportunity, but I think we're going to have to get through a little bit more shakiness in the economy to start seeing that compression occur.
Interesting. Peggy, you given your view on, where people are transacting, where do you see, the short and long-term prospects from a geographical footprint? Are you seeing greater and I think I know the answer, but are you seeing greater concentration in some areas over others, and where do you see it going?
Well, I have two opinions on that. One is more data driven. One is more on the experience that we're seeing with our investors. From a data standpoint, obviously, the Carolinas are still very popular. Florida as well. We're also seeing activity, Ohio, Indiana, Michigan. Colorado is still on the board. So it's all over. But one of the underlying reasons that we're seeing in the build to rent space is the readiness of the project. Is it already platted? Are we dealing with an experienced developer?
Mm.
You know, we've seen multiple instances over the last couple of years with an inexperienced developer that owned a large tract of land that decided he was going to develop it versus, you know, hiring the team that had the experience to get it off the ground.
Yeah.
So, you know, we've seen that, but the most popular areas, and I saw a question from the audience that just said, where are you seeing the activity? Number one answer is where the properties are ready to build. And it could be, you know, across the country. That seems to be one of the most attractive situations with the build to rent. But it seems like the most mature development is going on in the Carolinas, you know, Florida, Texas. They're still leading the way as far as having ready developments.
Yeah, and I think you touched on a really important point, especially for BFR operators or new BFR buyers that are coming into the market. You know, there's a lot of very astute land speculators out there that know how to buy land right and buy in good positions, but they're not historically developers. And if they decide that they are going to develop the dirt, you're negotiating with them to, you know, kind of be the end buyer of the homes. Be careful, and you know, because from the landowner's perspective, you know, if they're not an experienced developer and don't have the teams and the subs and the contracts, you know, they either may not get it done, or they may, but it might take twice as long and end up costing quite a bit more for you as a BFR buyer to get those homes up and CO'd and leasing, which, you know, speed to market and you know, cost is huge. So if you are working with, you know, a group that doesn't have a lot of development experience, you know, it may be worth, or if you're one of those groups listening that isn't a developer, you know, it may be more penny wise to spend a little extra to hire the right team to get your site developed efficiently, as opposed to, you know, trying to do it yourself. Very, very important point there, I think. Brad, I'd like on the build for rent side from a geographical perspective, because everybody knows that the Sun Belt is hot. And I feel like there's a lot of areas that don't get talked about a lot, which, you know, the Midwest, kind of the Rust Belt area, where groups like Redwood Living does exceedingly well. They have kind of a unique niche. You know, they only build 2-bed, 2-bath homes, but you know, are there markets that you think aren't being paid attention to for build for rent that, you know, maybe people should keep a little bit more of an eye on?
Yeah, absolutely. The Midwest, I think, has opportunities just partly because nobody's going there. You know, the capital has almost completely universally focused on the Sun Belt over the last, you know, 8 or 9 years. And so, you know, you think about markets, we've done a bunch of studies in, for example, Minneapolis, St. Paul.
Mm-hmm.
That's an extremely hot market for build for rent. Partly because it has one of the worst housing shortages in the entire country. And there's very few national builders there, or builders even of any moderate size. And the prices are very high on the homes. And so consequently, you can build 35-foot wide detached, you know, fairly small homes on small lots and rent them for $3,500, $3,750 a month, sometimes more. We've seen that repeatedly. And so, yeah, there a lot of money's being left on the table, so to speak. A lot of opportunities are being ignored because of the focus exclusively on the Sun Belt. There are some groups that are kind of trying to venture out into different areas, but that's the exception rather than the norm. And, a lot of people will argue, well, the Sun Belt is the safest place to go. It's proven, the population growth is happening there. People are still moving from New York to Florida. People are still moving from California to Texas and Colorado. But if everybody goes into the same market that is so-called safe, then it no longer becomes safe.
Yeah.
So I think it does behoove people to try to diversify and look in markets in addition to the Sun Belt.
Yeah.
Brad, do you think for just sorry to interrupt, but just kind of thinking about operators that are looking to target next projects throughout the country, I mean, do you think a good way to go about that is to target cities where property values are through the roof, and supply is, I mean, is that in your opinion where we see the most successful build for rent transactions occurring?
Yeah, I mean, nationwide, we're seeing the affordability issue like you talked about, Justin, and that's absolutely a big driver of build for rent demand. People who can't afford to buy, or it can be people who choose to buy. The renters by choice has gotten a lot of attention lately, but a huge portion of the market is people who just can't afford to buy, or for some reason just can't do it. So I think that in markets that are particularly expensive, that does drive more of the demand towards a rental solution, but it can also make it more difficult on the developer because the land is more expensive. So it's really case by case. I don't think you can make a blanket statement as to, only look at markets that have a home price above a certain level or something like that. You have to really look case by case at a holistic set of indicators to choose markets.
I think this dovetails well when talking about affordability, and everyone is concerned. Maybe they are, maybe they aren't. I don't know about a potential upcoming recession. Peggy, from your perspective, what are you seeing specifically in the scattered home SFR portfolio space, or some of the build for rent? But do you expect to see more defaults? Are there going to be some pre-foreclosures? Will there be foreclosures? And what are your thoughts on an upcoming recession or not?
So that's a very good question. We've already been involved in a deed in lieu transaction of a mid-sized portfolio. I do anticipate that what we will see is a portfolio purchase arrangement by the lending institution to go from one investor to the other, which is what we experience. It definitely is something to be considered. This was a mid-tier investor. It wasn't a a small operator. It was a mid-tier. So it was impactful, and it covered 6 states. So we do anticipate that we'll see more of those this year, but we will see them as a transactional deed in lieu rather than going back to the lending institution.
Interesting. And just give yes or no. Is there going to be a recession, or is there not?
I'm hoping not, but and I don't think that it's going to look the same as what we've seen in the past.
It never did.
I don't think that from the default side of the house, it's going to have the same impact. I think the workout upstream is going to be the major focus of any institution that we're seeing right now. The goal is to not have the reputational impact that they saw in 2008. So the goal is to definitely have a workout plan and not have it be a flood of default products that hit the market.
I've heard the same. I don't think the banks want to take the country back again. Justin, from your perspective, and loans, I know there's been a lot of loan pools that have been sold in recent months, but tracking loans that you guys made, maybe they were 2-year bridge loans at acquisition to do rehabs. How are things looking from your guys' perspective, and what do you foresee issue.
Yeah, and it this kind of dovetails maybe off what Peggy was saying, but to me, when I'm looking at potential foreclosures, it really is a matter of when the property was acquired, in my opinion, for these projects. I personally, to the recession question that you have, I certainly think that we are going to see a lot more, underlying issues in the economy over the next 6 to 12 months. Typically speaking, you expect a year or two after the Fed makes a decision to actually see the implications of said decision. So I think we still have a lot on the docket for 2024. And I'll talk about what I feel about the consumer here in a second. But to me, it's all about timing. And the reason I say that is if you have a property that you took ownership of back in 2020 or 2021, you may run into a distressed situation, but there's far too much equity built up in that property to run into, foreclosure, bank sale, et cetera. So there may be restructuring or certain things that come into play, but there's a lot of untapped equity in housing. And that's a massive protection, in my opinion, that, falls into that soft landing conversation that we hear the Fed talk about so often. But if I bought that property last year, it's a little different because my equity is not built up to the same levels that it was. And all of a sudden, those properties aren't quite penciling, and I don't have equity to tap into. So, it's one of those, check D, all of the above answers, right? But I do think that that's a big part of the conversation is when the acquisition took place. We certainly expect to see more inventory come to market. I don't see how more inventory doesn't, but I'm not sure I necessarily see it being a tidal wave due to that pent up equity that still resides in the majority of housing right now. But there's going to be a lot of opportunity without a doubt. And I think a lot of that's probably going to be driven by the consumer. And I personally don't think the average consumer's as healthy as it may look on paper and what you see in monthly prints from economic data. I think there's some problems that we have in the economy right now, but I do think the protection of home price appreciation, untapped equity, that's all going to play a part in marginalizing the impact of those foreclosure opportunities.
I agree. And Brad, I want to finish with you here, and then we'll have one more question for everybody and try to get about 5 or 6 minutes at the end for audience questions here. But in your view, having underwritten and done, countless feasibility studies in the BFR world, is there going to be any distress from operators? Are there going to be opportunities for investors in the next year or two on, projects that are finalizing completion or now stabilized? Any thoughts?
Yeah, I think that I wouldn't call it distress, but I would call it opportunistic opportunities to buy or somehow get involved in deals that maybe 12 or 18 months ago weren't available. And so that's why, cash is king. Those that have kept some powder dry or that have access to capital that's ready to invest in this environment. And, it's kind of a contrarian idea in a sense because everyone's kind of pulling back, but it's actually a great time to look for opportunities. I think that there will be some folks that are trying to refi that can't, or that are buying land for a build for rent deal and can't close. And so if somebody wants to get positioned for 2025, 2026, this is a great year. I think coming up in the next, 8 to 12 months, I think there will be opportunities to get deals on that kind of a basis. So I think it's an interesting environment.
I agree. So this is a question that everybody likes to talk about, and it's for all three of you. But people love talking about cap rates. What's the cap? Where are caps going? I've always thought it was a little funny because cap rates are not apples to apples. It depends on your scale, your cost of capital, how you operate. And there's so many things that go into a cap rate, but in general, whether it's, and let's do SFR, scattered home portfolios, and self-contained BFR communities. And I'll start with you, Justin. Where do you see, kind of the acquisition cap rates and disposition cap rates trending today? So if you're a buyer, what are you trying to buy at with a cap? And you as a lender, what are you allowing? And then as a seller, where do you expect to dispose today?
Yeah, RCN really focuses more on single asset transactions as opposed to, call it, I mean, we do a lot of multifamily properties, but, to kind of segment the conversation, if you will, really on a single asset property that we're lending upon, we just want to see cash flow positive. That's really what it comes down to, is being able to pencil a cash flow positive transaction. When you're looking at these multifamily transactions, however, I mean, it's fluctuating. Cap rates are fluctuating so much based on the rate environment we're in. And, if I'm thinking about what I foresee, and Michael, I think this goes to or I'm sorry, Brad, I think it goes to your point about, the opportunities today that present themselves for 25 and 26. We all know rates are going to come in, right? And there's going to be opportunities to refinance and create a little bit more stability and cash flow. But one thing we haven't touched on a ton, and I think plays a pretty big impact into how we view the world and we're forecasting these transactions, particularly our construction multifamily deals, where we know that exit is in 2 to 3 years, is the untapped rent growth that hasn't taken place. I think on average, we're still seeing 3-5% on a nationwide level for rent growth. And in some markets, I think there's a lot more that's there. A lot of the transactions that we see, there's tremendous potential to catch up, if you will, and create more cash inflow from that rental perspective. And we're kind of embedding that into our underwrites and credit analysis of these transactions that we're looking at, and just understanding that as the market moves, as rates come in, there is a lot more room for rent growth than there is for rent depreciation in our perspective, or our opinion, which is going to yield for more opportunities to compress that cap rate a little bit.
Thank you. Peggy, any thoughts on cap rates?
Actually, in my group, we really don't see that, but in my partnership group with PropStream and Stewart Valuation Intelligence, they're the ones that are guiding in this area. They've come up with some great products. PropStream's come up with some great retail searches to assist in local rent rates, and Stewart Valuation Intelligence has come up with good appraisal products to help guide there. So we do see the activity there and the contribution.
Yeah, and I for everybody listening, all great products that Peggy just mentioned, we use them. And Brad, just quick, and then we'll get to a couple of questions here from the audience. But how are you looking at cap rates? This year, say, where should a buyer be buying at? If they're buying that CO, what kind of cap should they be performing? And if you're a seller today, where do you think, the true, kind of disposition cap rate is going to be for equity and debt that are providing capital, and for sponsors that are trying to earn their promote by compressing their cap rate as much as they are. But where do you see these today?
Yeah, I think the spread between cap rates on BTR and on apartments will continue to narrow. BTR was perceived as riskier than apartments in the past, but less so now. And I think that a lot of it depends on what's going to happen with interest rates. The Fed, of course, going to ease and lower short-term interest rates. But what does that really do to the long end of the yield curve? I think that's more driven by Treasury issuance and demand for U.S. Treasuries globally. And I think that with this enormous, shocking budget deficit that we have and the amount of debt that we have, I think that long-term interest rates stay pretty high, possibly coming down a bit, but maybe not as much as a lot of people are hoping. But what that does is it continues to drive more people into renting and out of the for sale market. Hopefully the construction loans get better. Bridge loans are kind of pretty available, permanent loans, Fannie Freddie still okay, construction lending's tight. I think that the construction lending will get better. And then real quick on the subject of rent growth, I think that is something that nobody wants to put into their calculation as they look at deals. They want deals untrended. But I do think that a strong case could be made that rent growth will be back. And I think that, people are looking at year over year, income growth and rent growth. But month over month, we're seeing things starting to tip back upward. And the millennials are starting to advance in their careers as they get older, age into their 30s, mid 30s, and into their 40s. And so they're moving up. They're moving up in terms of income and in their careers. And they are paying maybe 28, 29% of their income towards rent. So still lower than the 33% where we can start to consider that there's problems. So I think that there's still rent growth to be had. So, that's another thing. I think people are missing out on deals by saying, I only want to look at the deal untrended.
Wonderful. And I'm just going to try to get through a couple of the audience questions here. Here's one. It's a little unique. I'm not particularly familiar with it or see much of it, but the question is, are you seeing more DST or 721 UPREIT sponsors buying BFR properties?
There are buyers out there. I think that you have to look at these are niche examples of buyers, and that's where we have to look, I guess. Like I said, we're still getting a pretty steady flow of demand, only down a little bit lately, just in the last 45 days for our study. So it tells me that there are still these groups that are open to buying. So you just have to look for the buyers in a different way and present the deals to them in a way that they want to see them.
Justin or Peggy, any thoughts on that question? Yeah. They've been around forever. I haven't seen a lot of those transactions in my time, but I know they're out there. They're unique strategies. Here's another question. And I think we kind of answered this, but gentleman's asking, when you talk about BFR in the West migrating to the East and Southeast, do you see much opportunity in the Midwest? If yes, which markets? If not, why not?
Okay, I gave my answer on that one earlier. Just it behooves one to look at markets outside the Sun Belt.
Yep. Yeah, I agree. And where there's jobs, schools, it's really jobs. If there's factories being built, semiconductors, auto plants, whatever it is, it's going to bring in 1,500, 5,000 jobs. That's where you got to track and follow. And if something's being built, it's going to be hiring thousands of people, probably going to need housing. Last question. When do you see BFR construction starts commencing to support 2026 and 2027 projections? Brad, maybe that's
I showed my forecast that I'm showing a 30% decline or so this year, then followed by a small increase in 2025, a slightly larger increase in 2026. It depends on when the capital becomes more available again. But the demand sooner or later is going to be so overwhelming. And by the way, the demand exists in the Sun Belt, Midwest, Minneapolis, St. Paul, California, everywhere. So at a point, the capital is going to start to go, wow, we sat out for a year and we missed a lot of deals. It's time to go ahead and rethink our cap rate, standards, rethink, not including any rent growth and all that. So plenty of opportunity.
I think to that point, and we'll wrap it up. But and per your slides, Brad, it really seems, and I think this works on both the single family portfolio side and certainly in build for rent because of the timing, the time that it takes to develop land and construct homes. But 2024 seems like the year to work on your strategy, get your planning in place, start putting deals together, whether or not you're executing and closing this year. Specifically in build for rent, it takes 12, 18 months before a project, you can even deploy capital if you're a CO buyer. But getting with those developer builder relationships, getting your plan in place. And on the SFR side, if you don't have capital today, it is a great time to put your business plan together, to start strategizing and getting ready to deploy. I think as soon as you can based on everything that we've just heard, rents are gonna pick up again for several years. So this seems like a good year to hunker down and really fine tune your strategy. And last comments from anyone before we take off.
I couldn't agree more with that. I think the tail end of 24, we're going to see a lot of that pent up capital on the sidelines start to re-enter the space, and the market will be receptive to it. And being prepared for that second half of 24 to engage in 25, 6, and 7 is, the time is now to be able to really do that on a meaningful level.
Well, if nobody else has any more questions or comments, I want to thank Justin and Peggy and Brad. And I want to thank everybody's marketing teams behind the scene that helped pull this together, including Sean and Amy on our team. And I just want to wish you guys all a happy new year, and wish you all the best in gearing up for what's hopefully going to be a prosperous year and several years ahead.
It's great to see everyone.
Thanks, everyone.
Thank you, everyone.
Thanks, everybody.